With that, let's bring in Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Thomas, thanks for coming back to Public Live today. Welcome back to The Close.
Thanks for having me, Anne.
So, Thomas, investors are becoming more bullish as markets close in the green. We're seeing some optimism that the Fed may pause in its rate hikes. What are your thoughts on what the Fed's actually going to do? It's got its hikes potentially or not coming up in its meeting starting tomorrow. So where are you landing on this?
Well, Anne, I think we're set up for the most hawkish skip in Fed history. They'll give us June, but whether the skip turns into a full-on pause is dependent on the inflation and employment data, which we're pretty sanguine on. When you look at expectations for tomorrow, they're not that aggressive in terms of core CPI at 5.3%, down from 5.5. But I think the headline is really going to grab a lot of attention tomorrow. Our base case is we're going to have a 3 handle in front of it. Expectations are for 4.1. And the reason we have that level of optimism, so to speak, is due to the high base effects of owner's equivalent rent year on year. And we're now rolling into the May, June, and July data when those rents peaked, the growth peaked last year. So if we get a 3 handle, I think that could be a big sentiment change for people's psychology around the direction that inflation is heading, and could bring some continued optimism in the markets. But we're not focused on the indices per se. We're kind of more interested in the 90% of the stocks that haven't driven the rally starting to participate. And I think that's an opportunity if we do get the skip.
Let's talk about that. That's the idea, Thomas, of market breadth, right? Not just looking at the market moves because they're driven so heavily by a couple of really big companies, but actually saying, look, irrespective of size, what direction are stocks moving in? Can you talk a little bit about the fact that the recovery in stocks have been fairly narrow so far, but it looks like we're getting a little bit of breadth back? What do you think of that?
Yeah, that's correct. And, I think we're coming into Q2 earnings season, and the setup is very similar to Q1. If you remember going into Q1, analysts were expecting negative 6 to 7% earnings. Instead, we got negative 2%, and it was a big beat. And now going into Q2 earnings season at the beginning of July, negative 6.4, and I think we could wind up again, negative 2 or flat. The other thing that's interesting, it's not just tech that's participating in these earnings revisions. Estimates have been going up. If you recall, since October, many of the sell-side strategists and analysts had been calling for 20% cuts to earnings, and the exact opposite has happened. In effect, we got a 20% rally in the S&P off the lows, and estimates the last kind of 4 to 8 weeks have been going the other way. They've been going up for 2024 at 247. So the key about the Fed meeting that's going to enable the breadth to broaden, to specifically answer your question properly, is that if the Fed has skips and then the data confirms what we think, where it gives them enough cover to maybe skip again and then ultimately turn into a pause and keep rates elevated, is that the dollar can resume that downtrend that it began in October, which, you had this short-term bounce of late into the debt ceiling because there was a bid to safety. If that dollar trend resumption downtrend continues, then here's what's going to happen. All of these multinationals that haven't participated, some industrial companies that get 50% or greater of their revenue from abroad, as the dollar weakens, that's going to contribute to earnings, and that's not in a lot of the models. Just a couple examples of what that could mean. Like Intel gets 82% of their revenues from outside the U.S. You get a resumption in the dollar trend, that's a home run. 3M, they've got a lot of hair on them, but they get 49% of their revenues from outside the U.S. PayPal, the most hated fintech, 47% of their revenues outside the U.S. Even VF Corp, clothing, shoe wear, that type of thing, 45%. Stanley Black & Decker, 45%. Baxter, 45%. So there's a lot of things to do. And then, of course, emerging markets and biotech as we get some comfort around rates stabilizing. So I think there's a lot to do beyond the quote-unquote Magnificent Seven that we kind of referenced earlier.
Flipping that around a little bit though, Thomas, let's take the other side of that, which is if you get a weak dollar, what is the risk we start importing inflation again? And just to break that down for the community, if you've got a weak dollar, it means for every dollar that you had to spend beforehand on buying some kind of raw material input. Let's take oil, for example, or let's take wheat or whatever else it is. If the dollar's weaker, you have to spend, $1.25, whatever, or whatever the hypothetical would be. What do you think about that in terms of putting inflationary pressure back on, Tom?
Yeah, historically, we've benefited more than it's cost us. And you make a salient point about the input cost, but we do produce a lot of commodities, both oil and grains domestically. But I think you're absolutely right. But the net effect on balance would be positive. And I think the other thing, too, coming out of the Fed meeting that we have to consider is, the short end may stay elevated for some time. But the minute that the market sniffs out that the Fed is kind of really going to pause, and I don't know that they'll give us that peace of mind in the conference. They'll give us a skip and a lot of questions afterwards. But then you see that 10-year start to get bid, and that's how commercials are positioned if you look at the commitments of traders. That could mean you get a situation where REITs start to get bid. Now, selective, across there's some risky parts of REITs, et cetera, but interest rate sensitive sectors like REITs, banks, and if banks start to stabilize, which we've been seeing, then all of a sudden you get small caps participating. And if you get small caps participating, then the breath really kicks in. And even if the indices like the S&P is a little bit subdued, maybe you get mid-single digits through year end, you could have stocks under the surface that haven't participated up, 20, 30, 40, 50%. And that's where the opportunity is going to be, is under the hood.
Let's talk a little bit about the retail sales outlook, Tom. We've got US sales data for the month of May set to release later this week. What are you expecting to see there? I was curious to know, is this a way to look at consumer health, or is something else going on with retail sales?
Yeah, I'm more inclined to be paying attention to services at this point in the cycle. But you do never want to underestimate the U.S. consumer. They always seem to come to bat when you least expect it. So I think it'll probably be in line with estimates. But again, I think the shift is material. It's gone to services. By the way, you saw it from Carnival this morning. They can't even keep up with the bookings. So I think you just have to look where the money's going. The key is it's circulating. The consumer's still alive. They want experiences. They want dining. Maybe some of that inventory destocking is starting to work through, and maybe we'll see some more positive results in retail sales. But on balance, so far so good. Earnings, so far so good. And I think that the sea change that's going to speak to your critically important breadth question is going to be, if we get enough level of confidence that the Fed is kind of stepping back and that dollar weakens, I think we can see so many companies start to participate in this rally and make it a very, very healthy, confirmatory, real bull market, not just a technical, arbitrary number of 20% off the bottom.
So let's move from the markets to the real economy, Tom. They're related, of course. But on the one hand, we're seeing what looks like a bull market now. We've got green across the screen. We also still have talk that there is a probability of recession. It's a really interesting moment in time where we're sort of moving up and to the right, at least in some stocks. But there's still talk that we're not out of the woods when it comes to the day-to-day. So where do you stand on recession versus no recession?
We've been in the soft landing camp. We've been, kind of bullish since October. If you go back to all of our public stuff, pretty aggressively, particularly on the positioning. If you look at where institutions are still positioned, and there's a catch-up trade here, and you look at net shorts of S&P futures, they're still aggressively short. They're going to have to chase up. You can't have earnings continue to go up and be underpositioned and keep your job. So I think that once there's confidence that these earnings are real, and we're going to see that in coming weeks, that the Fed is out of the way, where are they going to go? They're not going to be chasing the things that have led the rally, the Magnificent Seven, because they've kind of run a lot. But as a manager, you got to chase the things that haven't yet participated, so you can still get your performance and not get whacked in the head if the things that have moved up 20, 30% take a little breather. And I think that's the kind of environment we're going to see through year end. You may get some people chasing the things that are up that aren't going to work quite as well as they did the first half of the year. And then the things that no one's really wanted start to get bid and confirm that the economy is stable, earnings are stable, and if that's the case, people are dramatically underinvested. And particularly with less competition from yields, people are going to want to get returns elsewhere, and maybe that's back into equities.
Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Thank you so much for coming back to the close. It's always good to have you on.
Likewise.
And that will do it, folks, as we head into that closing bell. It is going to be a big 48 hours now coming up as that Fed meeting happens and we understand whether there is going to be a skip or a pause or a hike in interest rates. We'll be keeping you updated real time here on Public Live. See you all soon.